In this video, I want to talk about fair value gap, FVG. So a fair value gap is basically a series of 3 candlesticks whereby the middle candle has a huge gap in between them. Now, this is as a result of price moving very fast in a particular region. So price moved very fast, and because of that, it left a gap. How do I know there's a gap here? Basically, if you look at this candle here, it is very big compared to every other one you can see right here. And in between it, you can see a gap. Where can you find this gap? From this area here up to this area here. Let me change this to white. So you can find a gap from here to this area here. So in between this is your fair value gap. So the most important thing is it must be a series of 3 candles, and the middle candle need to have a very huge gap. Now, sometimes it mustn't be as big as this gap you can see right here. It could be very small. So let's say something like this. Let me take this out. It could be very, very small like this. But what you can still notice is there's a gap in between this area and this area here. So far you can find a gap in between them, then there's obviously a fair value gap in this area right here. So you can drag it as much as you want to drag it. Even if I reduce this to a smaller size, and then in as much as you can still find a gap, regardless of how small it is still a fair value gap. So let's say we have more candlesticks at the top here. Now, what most persons are expecting is, in as much as you've been able to identify that this is an uptrend, what you want to do is to take the market to look at the gaps in here, and whenever the market is reacting, it comes back to this region, you take a long position. Since you've confirmed that this is still an uptrend, you take a long position from here and target upper prices. So doing that, what you're going to do is just to place your entry point here, and your stop loss slightly below it, and then you target higher prices. This is basically how you trade your fair value gap, although there is more to this, and you can't just accept everything I've said right now, because I'm going to give you several analogy as to what you need to understand very well for fair value gaps before you can actually trade them, and what you should look at. Also, watch this entire video if you want to find that out. Before I start this video, if you don't have an account with Wix, which is one of the top leading crypto exchange, then use my link in the description to sign up right away. When you do that, you're going to receive free bonus for using that link to sign up. Check out the link to sign up right now, and let's get started with this video. Now, the next thing I want to talk about is equilibrium, or some persons call it 50% equilibrium, depending on what you want to call it. Now, after I talk about this, then I'll go to real chart and explain better for you. Now, what this simply means is, let's take out this here and let's go back to when we had our fair value gap. And I want to elongate this fair value gap to be higher. And let me take this to the upside. All right, so let's say we had this fair value gap right here, and then let's say there's a little more series of candle at the top here, and we have been able to identify our gap, right? Now, the concept of 50% equilibrium is basically that whenever you want to take a trade, you don't want to take a trade randomly inside your gap, that is inside the gap itself. You want to only take trades in the 50% equilibrium. Now, how do you identify that? It's simple. Go over to this area where you can find Fibonacci retracement and click on gain box. And what you're going to do is to drag this from here to this area here. Now you can see this area labeled as 0.5. This is basically your 50%. And this is where most persons want to take trades from in a gap. So let's say we want to take a long position, for instance. We want to take it, we're taking it from the 50% of that fair value gap, not the full trend you can see right here. Inside the gap you found, you basically take trades from the 50% of it and ride it upward. So let me drag this very well and put it in the right position. We're looking at this right here. What you're expecting is you want to see the market come back, react here, but you're not going to take any position here. You're only expecting to take position when it gets to the 50% region inside your fair value gap. So you take a position here and ride it to the top here. So this is basically the concept of 50% equilibrium, but we're also going to talk about entry models and how you can actually identify them. So let's go over to real chart right now. Let me show you how to identify fair value gap and how you can use them. So here we have Euro USD. Now looking at this right here, well, we can identify that this is actually an uptrend. We have higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Now over here I can identify several fair value gaps. Let's go ahead and do that. First, I'm going to start with this right here. We have a gap in between this area here. I can drag it as much as I want. So there's a gap here. There's also another gap here from this area here to this area here. And there's also another gap here from this area here to this area here. And there's also another gap here from this area here to this area here. I can drag it back or forward. And this is basically how you can identify fair value gaps. Now, I know we have several fair value gaps, but there are a lot of things you look out for when you're trying to explain this gap. Now, the first thing to understand is the concept of mitigation and unmitigation. Now, whenever you look at this area here is a fair value gap, right? We moved and then we went upward. Now, what you can see is the moment we went up here and then we came down, we tapped this fair value gap and started going upward. So automatically, this area here has been mitigated. So we are not going to use this as our actual fair value gap. The next fair value gap we can see is this area here, but what we can see is we went up, came down and tapped it. So automatically we've actually used this fair value gap. So this is no longer the fair value gap we are looking at, right? So you can take this out. And even this one has also been mitigated, right? We created this fair value gap, went up and then came down, and we've actually filled the gap. So automatically this is actually mitigated. The only one that is not mitigated is this one you can find right here. But I've been able to explain to you how you can draw your fair value gap whenever you see them. All right, so let's treat that of a downtrend. Now, if you look at this very well, we are basically in a downtrend. We're printing lower lows and lower highs. And over here, we've actually broken structure, which you can see right here. So we want to identify our gap from in this area here. Here can you find your gap? Simple. You can find a gap from here to this place here. I can drag this to the top, to the side. You can also find another gap here. And this is the gap. Where else can we find the gap? There's no other gap here, right? So this is for a bearish trend, and you can see that the moment the market came here, although it did not tap into our gap, so we would have basically missed out the trade on this. But this is actually the gap for a downtrend. And if you look very well, we've basically been going down, we've broken another structure here, showing that this is still a downtrend. Can you find any gap here? There was a gap in here, but you can see it has been filled already. There's no other gap in this area except for this area here where I can find the gap. So this here, there's a gap in here, a very small gap. And then let's go forward and see if we can find more gaps. So we are still in a downtrend. You can see we also broke structure here again. So can we find any gap here? Yes, we can find, and the gap is basically this gap in here. All right, so and then looking down here, you can still see more gaps. There's another gap here, but you can see this gap has been mitigated because market came tapped in here, so it has been mitigated. And you can find more gaps here, here, and just like that. This is basically how to draw your gap. You can see it's not difficult at all. So now I've been able to show you how you can draw the gap. So let's go over to the rules and regulation of fair value gap. And after that, we are going to treat real life examples where you can actually apply fair value gaps. All right, so let's go over to the rules of fair value gap. The first rule is it must follow a trend. What is a trend? Trend is simple. Uptrend or downtrend. So this is basically an uptrend, printing the higher highs and higher lows. So what you're basically going to do is to identify where you can find your fair value gap in here. Let's go to this real chart here and let's look at for examples. So if you look right here, this is basically a downtrend, right? We've been going down, printing a lower low, a lower high, lower low, lower high, lower low, lower high. So where can you find the gap? So for every time we have that, the gaps are basically the ones you should be looking at for. So we should be following a trend. So what you want to do is, in a situation like this, you want to see us have something like this. We go up and tap here, and then maybe we are shorting and then we short downward. In other situations, maybe here is our next gap we are picking. We short from basically here and then go downward. We don't want to do the opposite thing whenever we are trading. So we want to follow a particular trend. If it's an uptrend, what you want to do in an uptrend is you want to wait for markets to retrace back to your fair value gap, and then you enter a long position, target upward. Whenever it breaks structure again, you target the fair value gap again, and then continue like that upward. The second rule is it must break structure or change character. So a BOS or a change of character. Let's go over here again and let's look out for what we can see. So I'm going to take out all of this drawing and let's redo all of these things. And let me move this sidebar so it doesn't get clustered so much. Okay, so looking at this very well, we are basically in a downtrend, right? Now we've been able to identify the trend. The next thing is we want to identify if we are breaking structure or we are changing character. For a downtrend to be confirmed, we must always break structure. So look at this very well. We came down, we did break structure here. You can see it, showing that this is still a downtrend. So any fair value gap here is actually the valid ones we should be looking at to trade, right? And you can see this actually came in here perfectly. And you can see the moment we broke structure, you can see it came in here perfectly. If we had a long position, a short position here with our stop loss below here or maybe here, and then we target lower prices, you can see this was a perfect trade, right? So let's play this forward and see what happened next. What did you notice next? We did break structure again, which is this one you can see right here. So I'm just going to shift this a little so it doesn't disturb us. So once we've broken structure here, now what we want to identify is where are the gaps we can see from this region down here, from this area down here. So I can basically find a gap here. There's no gap here. This is basically the gaps I'm seeing. Only this gap is what I'm seeing right there. So let's say we had our short position here with our stop loss slightly below it, and then we are targeting lower prices. Okay, let's see what plays out here. You can see we didn't get back to this fair value gap here, but we did continue going down or broke structure again. And then we just have to identify where is the gap after we've broken structure. You can see the gap here. So you keep trading it like this as it's going, breaking structure and going downward like that continuously. So let me show you one for change of character. Now looking at this chart very well, you can see we are basically in an uptrend. We went high, came down and printed a lower high, a higher low, printed a higher high here when we broke structure. Although some persons are not going to mark this as BOS, but many times I do mark it as BOS too. So we broke structure and then printed a lower high here and then went upward. But what did you notice here? We actually had a change of character in here. So this is for change of character. So where can you find your gap? I can basically find gaps here. I can also find gaps here. So, and let's say we are taking any of them for trade because we have a change of character, right? So let me label it so you see it very well. So CHOCH here. So we have change of character here. And then let's say we are shorting from this particular one with our stop loss either below here or slightly to accommodate this particular gap here. We'll take it a little bit upward and then we target lower prices. Now let's see what actually played out. You can see it did tap this particular entry point. Look at it here. It did tap this entry point here and basically came down. So this was a perfect trade for us. So that actually answers this number 2, which is change of character or BOS. Next one is it is only for a one-time use. Now let me go here and let me show you what it means to be a one-time use. So we got this trade here, right? I'm going to take out all of this drawing so we focus on just this area here. So let me also shift this a little bit. So we got this trade here. Now what did you notice? When we came here, we didn't tap this fair value gap. We only tapped it once here. Now imagine if we came back again and then tapped this area here, and then some persons that want to short. This is actually a wrong thing to do, to short the market from this fair value gap here, and that actually breaks the third rule, which is for only a one-time use. You must not short from here once the fair value gap has been used. For this one, we have basically used it. So the second time is coming here, we're not going to short the market from this particular fair value gap anymore because it is only supposed to be for a one-time use. What I'm expecting in this kind of situation is most times it might do as if it wants to respect it, and then what you just see is we go upward and break the fair value gap and continue upward. So that is why I want to focus on it for a one-time use. Now, oftentimes it doesn't mean this second one would not count the second time. It might count sometimes just so it breaks, just so it shows you that okay, it might work, but it doesn't mean it's going to work every time, because the third time is coming. If you short again, there are chances that it's going to sweep above it and actually change character. So what you want to do is you only want to use it for a one-time use. It is very important. And then the last rule, which is actually optional, is the best fair value gap are usually in the premium or discount zone. So I'm going to show you what that simply means. All right, so looking at this trade here, which is one of the examples we used. Now, what I want you to identify is we broke structure here and then we broke structure here. Where is our highs and where's our lows for the range? This is basically the top. And this is basically the lowest part of our range, right? So we want to mark that out. Now, the next thing you want to do is to go to your Fibonacci retracement, this area here, and pick the gain box once more. And what you want to do is to draw from this top to the bottom here. So anything you have from this 0.5 to 0 here is actually your premium region. And this one down here is your discount region. All right, in this kind of situation, we'll be able to identify our premium region and our discount region. Now, we only want to take trades from this 0.5 upward here. So what we want to do is to mainly focus on trades in the premium region when we are shorting. And when we are longing, we want to focus on the discount region. This way, we get the best entry point. I'm going to give you an example. Let me take this out. Now, let's say let's say we're able to, I'll just use something random. Let's say here, this is the random thing, not a fair value gap, right? But let's say this was a fair value gap, for instance, and then we basically short from here. Now, you can see that we have this whole area as our stop loss, and we target here. You can see where we don't even get a one risk to reward one. So it's going to be very, very difficult for you to be able to draw out areas, except even though you put your stop loss slightly below here, you can see we still did not do a very risk to reward ratio here. It's just one risk to reward 3.4. So that is why shorting from discount sometimes doesn't give you the best opportunities for risk to reward. So focusing on the ones for the premium region here gives you a better risk to reward, and that also applies to when you're longing. You want to long from this discount region and target upward prices, and not longing from here and targets here. It's not going to make a lot of sense in terms of risk to reward. But although it doesn't mean you can't short it. You could short it sometimes, but that's why I said it's optional. You just have to check out for it whenever you're taking your trades. So let's go back and let's draw back our gain box, and this is it here. Now, where are the fair value gaps you can find in this 0.5 upward? I can basically find this one here. I can't find any other one, but in situations where I can find this one here also, let me show you this one here. But you can see it's been mitigated already because we tapped in here. I'm going to take out this thing here. We tapped in here, so it's been basically mitigated, and it's still not, you can see it's also it's below a 0.5 region. So I don't want to take this one as a perfect fair value gap. So I want to focus on the one from here to the upside whenever I'm shorting gets that correctly. Okay, let's take out this gain box. So that is basically what it means for premium and discount. So let's give another analogy with this right here for discount. Okay, looking at this right here, we were basically in a downtrend. I'm putting in a lower low, a lower high, a lower low, lower high, and a lower low, a lower high here, a lower low, and all of a sudden we had a change of character here. So if I have to draw my gain box from the top to the bottom, for instance, where can we find our 0.5 region? Anything from here downward. Now, where are the fair value gaps you can see here? I can basically see a fair value gap here. Although we can see it taps the first time, tapped again the second time, and it's tapped here the third time. So even though this trade played out very well, what I want to show you is, yeah, it had multiple taps here, but in this situation, we only want to long from here. Although this is not a perfect example, but we only want to take long position from 0.5 to 1 here, which is our discount region, and this is our premium region. So this is when you're going for long, you want to take from this down here to the top side. And then when you're not taking from here upward. And then when you're shorting from up here down. You're not shorting from here downward. So I just want you to understand the concept, even though this did not play out perfectly. All right, so with that, we've been able to assess the 4 rules you've been able to follow whenever you're trading your fair value gap. One other thing I didn't mention is For the equilibrium, for those that like to trade the equilibrium, what they want to do in this kind of situation, once they found out their fair value gap, is to draw a 0 point from here to identify the best zone in this area here. And then let's say we want to short it, we are basically going to short inside of this place with our stop loss slightly below here, and then we target lower prices. This gives us a better risk to reward. But what you can see very well here is this trade did not get to this 0.5 area in this our fair value gap. It only tapped here and came down. So sometimes it works, sometimes it doesn't. You're going to miss trade sometimes, but it gives you a better risk to reward ratio whenever you're taking trades using the 0.5 equilibrium, which I talked about earlier in this video, for your entry points whenever you're trading fair value gap. But imagine someone that took his trade there and then stop loss slightly below here. What you can see is he's doing a 1 risk to reward. I'm just going to check. This is the 1 risk to reward 3.6. But you can see someone shorting from here, from this 0.5 area here, with stop loss slightly above it, and then it's targeting lower prices here. You can see it's doing 1 risk to reward 8. So this gives you a better risk to reward, but there are chances that you might miss some trades whenever you only focus on the 0.5 region. What if we have multiple fair value gaps in a particular area here? Which of the fair value gap is the best we can trade? Because right here we have 2 fair value gaps here, so which is the best to trade? First, we want to identify with our gain box to see is if it's in a premium or discount. So this is premium, and if you look at this, this is actually an uptrend, right? So we want to long from premium, so 0.5 down here. So this shows that this 2 fair value gap is actually in the right discount area where we want to take long position upward. So which is going to be the best to trade? The first thing I want to tell you is whenever you have 2 fair value gaps, the one in the extreme is basically the best. What do I mean? This fair value gap here is basically the best. If you get an entry here, is actually the best. There are chances that you might win the trade and then you long it upward. But there are situations where it doesn't come to the extreme. It might just come to this one and then start going upward. So what I want to see is, I want to see this market coming down. So I want to see something like this. So I want to see something like this. It taps here and instantly bounce off immediately. The moment it does something like this, and then I wait for a retracement here and take a long position upward. Now what actually played out here is we're basically doing a lower low, lower high, lower low, lower high, lower low, lower high. And what did you see here? Lower low again, lower high, lower low. And all of a sudden we did change of character here, showing that this trend is exhausted and we might start seeing market shift character to the upside. And what I'm going to do is to look for a long position in this area here of this candlestick with my stop loss slightly below it, and then I'll just take a long position upward. So this is basically called a confirmation entry. So I want to see some level of confirmation in this area here before I will enter. So if I don't see anything like that, maybe I see something like this, when the markets come down, just do something like this, sweep it, I'll just basically target this area here and target long position. So I want to see what plays out here. I want to see that the market reacts from this area instantly. The moment it taps in, it should basically react from it instantly. Should basically bounce off from it instantly, showing that this area here is a strong area that would obviously hold. Once I've seen something like that, then I know that this fair value gap here is strong. I just have to look for confirmation entry going to lower time frames with 15 minutes or 1 hour or thereabout, and I should get my entry point in this area here to take a long position upward. So that is basically called confirmation entry. But I have a separate video about entry points, so you want to check out that video when it's live to actually find out more about it. Now there's another type of entry which is called an aggressive entry. Now an aggressive entry sometimes might fail you, but an aggressive entry is basically this: you spot your fair value gap and you set your entry there with your stop loss slightly below it, and then you target higher prices. This is actually an aggressive entry, and there are chances that it might just come, sweep you out, and then continue going downward, react on this one and go upward. Now in this kind of situation, some persons might still come here and go long. So imagine if this turns out to also be a bad trade. That means you've lost 2 times just because you use an aggressive entry. But it does work many times, and most of the times when I like to apply it is when we just have we don't have multiple fair value gap, and there are chances that this one is going to, that's when let's say we only had one fair value gap, which is this one here. I'll just use an aggressive entry here. I don't have to stress so much about it, in as much as I know that this is the only fair value gap. There's no need to wait for confirmation entry. I can still use confirmation entry in this area here. It's basically work. All right, so the last thing I want to talk about is the concept of FVG, which is called inverse fair value gap. Now, what is inverse fair value gap? It's simple. With the understanding you have here, so we have two fair value gap here, but let's assume only this one was the fair value gap. We don't want to use this one for this example, since it's going to make everything simple. So let's assume we only had this fair value gap. IFDV is simply the market coming down. Instead of holding here, it breaks here. The moment it breaks here, what we want to do is this area here shows that this fair value gap, we're no longer going up. It has actually changed character and it's not serving as an inverse fair value gap. So we want to basically take a short position from here downward because it has basically broken structure. So we want to short from here downward. Oh, obviously we're waiting for a long position here previously, right? We're waiting for markets to come here and then bounce up, yeah, right? But in this kind of situation where it, instead of coming down to bounce here, it breaks this fair value gap here, closes below it with a body, what you're going to expect is we retrace inside there and then you take a short position and target lower price, start going lower. So this is simply what inverse fair value gap is. So whenever you've experienced something like this where when we do break a fair value gap, automatically it serves as an inverse fair value gap for us and we can start shorting from that particular region. So this is basically what inverse fair value gap means. It is very, very simple. You can check it out on the chart and be able to apply it. So this is all of it about fair value gap. I hope I was able to do justice to this video, and we have a lot more videos of our technical analysis series in this channel. What you just have to do is to check out our videos and watch them. We have some other ones that will be coming after this one. As a matter of fact, I'll be making another video. I'm making a video right now on supply and demand, which is going to be the next video after this one goes live. So you want to check out all of the series on our channel to watch these videos. Please make sure to like this video and subscribe to this channel if you are gaining value from all of the things we've been putting out on this channel so far. And if you want to watch the video about market structure, where you're going to learn about break of structure, uptrend, downtrend, and change of character and the rest of that, then click here to watch now.